Hello everyone. Welcome to EduTap and welcome to today's Finance 360-degree session. First of all, do tell me if I'm clearly audible and visible. There was a technical issue that came. I hope it is I'm clearly audible and visible to all of you. So today we are going to discuss a very important RBI press release, that is the RBI monetary policy for October 2025. As you know that your exam is near and this monetary policy statement has been released just before your examination. This was released on 1st of October. So it becomes very, very important from the examination point of view. Okay. So we will discuss that what are the changes that have been brought. There is the change in the forecast. The GDP forecast, the real GDP forecast and the CPI inflation forecast has been changed. Why they have been changed, what are the reasons behind it, as well as what are the new percentages. All of this we are going to discuss in today's session. Okay. So today we are going to discuss about the changes in percentages as well as why they have been changed. Because in the previous year phase 1 examination, we have seen that directly the reasons were also asked in the question and the reasons were given in the options and you had to mark the correct one. So today's session is going to be important. Okay. So everything is fine. Okay. Chalo, let's start with the session, but before that, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos and join our Telegram channel where you will get the PDF of the session. Okay, so the link for the Telegram channel is provided in the description box below, and in the Telegram channel you will get the PDF. So starting with the news article for today, starting with the monetary policy statement that was released on 1st October 2025. Okay, so in the monetary policy committee there are 6 members. 3 members are from RBI, 3 members are nominated by the central government. Okay, and the chairperson of the MPC is the governor of the Reserve Bank of India, that is also the member from the RBI. Okay. So that is the idea. So Monetary Policy Committee held its 57th meeting from September 29 to October 1, 2025 under the chairmanship of the Governor of the Reserve Bank of India, that is Shri Sanjay Malhotra. All the other 5 members were also present, as well as the governor, that is also the member of the MPC, he was also present. Okay, so the MPC members, Dr. Nagesh Kumar, Shri Saugata Bhattacharya, Ram Singh, Poonam Gupta, Shri Indranil Bhattacharya, they were also present in the meeting, and this was the 57th meeting of the Monetary Policy Committee where it has been decided to keep the repo rate unchanged. So it has been decided to keep the repo rate unchanged. Remember that the repo rate was changed in February 2025 by 0.25%. Then in April 2025 also the repo rate was decreased by 0.25%. Then in June 2025 also the repo rate was decreased and it was decreased by 0.5%. So since February 2025 till June 2025 there was a decrease in repo rate initially by 0.25% each in February 2025 and April 2025, and then in June 2025 also the repo rate was decreased but by 0.5%. Okay, now in August 2025 meeting as well as in the October 2025 Monetary Policy Committee meeting, it has been decided to keep the repo rate unchanged at 5.5%, because initially you can see that there is a lot of decrease that has happened in repo rate from Feb till June, from 6.5% to 5.5%. Okay, from 6.5% the repo rate was decreased to 6.25%, then to 6%, then to 5.5%. Okay, so in February 2025 the repo rate was decreased, then in April 2025, then in June 2025 the repo rate was decreased, and in August MPC and in October MPC it has been decided to keep the repo rate unchanged. Any confusion here? This MPC, this Monetary Policy Committee you have to focus on, because this is near to the examination. Okay, so remember that the Monetary Policy Committee has decided to keep the repo rate unchanged at 5.5%. If the repo rate is unchanged, that means, see, repo rate is a part of liquidity adjustment facility corridor. So if repo rate is at 5.5%, the SDF rate, that is the deposit rate of the RBI, this is at 5.25%. Okay, and the MSF rate and the bank rate they are at 5.75%, okay, because the SDF rate is less than the repo rate by 0.25% and MSF rate is higher than the repo rate by 0.25%. So if the repo rate is 5.5%, SDF rate is 5.25%, MSF rate and bank rate is currently 5.75%. Repo rate is the lending rate of RBI at which RBI provide loan to the banks. SDF rate is the deposit rate of the RBI at which RBI takes the deposit of the banks. RBI take the deposit of the banks, okay. MSF rate, it is also the lending rate at which the RBI lends to the banks. RBI provide loan to the banks if the banks have already utilized the limit of repo rate, if the banks have already taken the limit of the loan under the repo rate, because the banks have a limit of the loan that they can take under the repo rate. If they have already utilized that limit, if they want more loan, if banks want more loan, they can take it under the MSF rate, but that is a higher rate than repo rate. Now MPC has decided to continue with the neutral stance. Neutral stance means that the RBI MPC can decide to increase the repo rate in the future, decrease the repo rate in the future, or keep the repo rate unchanged. So this is the neutral stance, that in the future whatever decision can be taken. So this is all. Any confusion, anyone? Any confusion? No confusion? Okay. So basically from Feb 2025 till June 2025, in these monetary policy committee meetings, it was decided to decrease the repo rate, okay, initially by 0.25%, then in April also by 0.25%, and then the repo rate was decreased in June 2025 by 0.5%. So from 6.5%, the repo rate was decreased till June 2025 till 5.5%, okay. And now in August MPC and in October MPC, repo rate has been kept unchanged at this lower percentage of 5.5%. So SDF is 5.25%, MSF is 5.75%, and there is a neutral stance. Now growth and inflation outlook. So we have discussed about the percentages for repo rate, MSF, SDF. Now coming to growth and inflation outlook. So global economy has been more resilient than anticipated in 2025 with robust growth in US and China. The outlook, however, remains clouded because of the policy uncertainty, because of the tariff regime of US, we can say, or there are a lot of policy uncertainties at the global level. Inflation has remained above their respective targets in some advanced economies. Now inflation is above the target for some economies, for some advanced economies. Now this is a problem, because if the inflation is high, the central banks of the advanced economies, they will have to increase their important rates. They will have to increase their interest rate, so that at the higher interest rate, people take less loans and the demand decreases, and with the decreasing demand, the inflation can be controlled, okay, and the inflation rate can decrease. So basically there is higher inflation above the target in some of the major advanced economies. So with the increasing inflation or with the higher inflation, these economies might decide to increase their interest rate, their policy rate, their interest rate, so that the inflation can be controlled, okay. So this is a new kind of challenge that is arising in the advanced economies, and with the volatility that is also arising. The financial markets have been volatile, okay. The US dollar has strengthened. The US dollar value is still increasing after the upward revision of US growth. As we have seen that there is robust growth in US and China, and with the robust growth in US, there is US dollar valuation that is still increasing. So US dollar strengthened after the upward revision of the US growth numbers for the second quarter, and treasury yields hardened. As I have told you that many of the central banks, they have decided to increase their interest rate, or there is the expectation that they might increase their policy rate, they might increase their interest rate to control the inflation, okay. So treasury yields have hardened. The interest for the government securities is increasing recently, tracking changes in policy rate expectation, because there is the expectation that the policy rate is going to increase to control the inflation. The interest rate is going to increase to control the inflation, and due to this policy rate expectation, the interest rate for the treasury bonds, for the government securities, have started to increase at the global level, especially for the US treasury bills, okay. Equities have remained buoyant, that is shares have remained buoyant across several advanced and emerging market economies. That means they are holding their value. Any confusion here? Tell me very fast if there is any confusion, yes or no. I'm going a little faster because we have a lot of data points to discuss. The governor's statement has also been released, so I'm going to discuss that also today. And I don't want to waste a lot of your time. Any confusion here? So basically, global economy has been more resilient than anticipated. US and China have seen a robust growth. But there is the uncertainty when it comes to inflation. The inflation has remained above their respective targets in major advanced economies. To control the inflation, these economies can increase the policy rate. With that, the interest rate will increase. And with higher interest rate, loans will decrease, demand will decrease, and inflation can decrease. So it is expected that the policy rate is going to increase in the future, due to which the treasury yields, the interest rate for the treasury bonds, government securities hardening in US and major economies. Okay, this is the idea. Chalo, moving forward, in India, real GDP driven by strong private consumption and fixed investment. So real GDP growth was 7.8% in quarter 1 of 2025-26. So quarter 1 2025-26 was April 2025 to June 2025. So in this time period, the real GDP has been driven. So in the quarter 1 of 2025-26, the real GDP growth was 7.8%. That is quite a high growth we can see. Okay, so in India, real GDP, because of the strong private consumption and fixed investment, the real GDP recorded a robust growth of 7.8% in the first quarter. On the supply side, the gross value addition at 7.6% was at 7.6% in the first quarter of 2025-26. So you can see that real GDP has grown by 7.8% in the first quarter, and the real GVA, the real gross value addition, has grown by 7.6% in the first quarter due to the revival. Now GVA has increased, gross value addition has increased because of the revival in manufacturing and steady expansion in services. Available high frequency indicators, that is the high frequency data. It refers to the data that is available frequently instead of quarterly or annually. So this is the data. High frequency data is the data that is available frequently, more frequently. So available high frequency indicators suggest that economic activity continues to remain resilient. In the first quarter, the GVA and the GDP growth was quite high. It was 7.6% for GVA and 7.8% for GDP in the first quarter. Okay, now it has been shown by the high frequency indicators that the economic activity will continue to remain resilient. Rural demand remains strong, riding on a good monsoon, robust agriculture activity. Urban demand is showing a gradual revival also. Revenue expenditure, so the expenditure of the government registered a robust growth. The regular or general expenditure, general day-to-day expenditure of the government has shown robust growth during the fiscal year so far, that is from April to July. There is higher revenue expenditure that has happened, due to which more expenditure, more government expenditure means more demand in the economy. More demand in the Indian economy means more production, more growth in the economy. Investment activity, as suggested by healthy growth in the construction indicators, is holding up, even though production and import of capital goods have witnessed some moderation. So investment activity is showing healthy growth, especially in the construction area, cement production, steel production, even though there is decrease in, or there is moderation in the production and import of capital goods. Capital goods are the machinery, tools, equipments and such. Recovery is happening in manufacturing sector as well as service sector is also sustaining its momentum. So basically the gross value addition is improving. The growth is happening in gross value addition due to manufacturing and steady expansion in services. The GDP growth is happening because of private consumption and fixed investment. The government expenditure is also increasing. Revenue expenditure is increasing. It was robust. Investment activity is also good in our country, even though the production and import of capital goods have moderated, but the other areas are working very well, are very strong. Rural demand is also strong. Urban demand is also reviving. So in our country, if we see, most of the parameters are on the better side. Manufacturing sector is reviving. Services sector are steadily expanding. Above normal monsoon, good progress of Kharif sowing, adequate reservoir levels have further brightened prospectus of the agriculture and rural demand. Okay, even if we see for agriculture, we saw for manufacturing, we saw for services, even if we see for the agriculture, this is also good. Buoyancy is in services sector, that is steady expansion of services sector coupled with steady employment condition are supportive of demand. As well as what has happened, GST rates have been rationalized, due to which it has been said that the prices are going to decrease. Because of the GST rates rationalization, prices are going to decrease for major commodities, for many of the commodities, and with the decreasing prices, demand will increase. So this is the idea. What, Uday, which point is not clear? Which point is not clear? Is there any point that is not clear? Next, rising capacity utilization. That means the machinery, tools, equipments, their capacity utilization, their utilization is increasing. That means they are being used by the units, by the factories at the good capacity. Conducive financial conditions. Okay, there is good financial conditions. Improving domestic demand should continue to facilitate fixed investment. So this is the idea that we are using, the companies, the factories, they are using the machine, tools, equipments to the maximum capacity, and there is good financial condition. There is improving domestic demand also, due to which it is expected that there will be more fixed investment that will happen. New factories, new units will be laid down. More machinery, tools, equipments will be demanded by the companies. Okay. However, ongoing tariff and trade policy uncertainties will impact the external sector for goods and services. Okay, so because of the tariff, because of the trade policy uncertainties, there will be a problem in the export. There will be problem in the export demand, or the export demand can decrease because of the tariffs that are being imposed by the US, or because of the trade policy uncertainty, the export demand might reduce. Next is prolonged geopolitical tension and volatility in international financial market. So there is geopolitical tension that are stretching out in various countries, as well as there is volatility in the international financial markets caused by risk of sentiments of investors, also pose downward risk. Okay, so there is volatility. There is volatility in the international financial market. Okay, this is because of the risk factor for the investors. This also poses downward risk to the growth outlook. The implementation of several growth inducing structural reforms have been taken. So for the growth of the country, there are structural reforms that have been taken that include streamlining of goods and services tax. They are expected to offset some of the adverse effects of the external headwinds. So the problems that are coming from outside, the trade policy uncertainty, the tariff, the geopolitical tension, due to that, the problems that are coming in, that is being to an extent resolved through the internal steps, that is by rationalizing the GST, streamlining the GST, and such steps are being taken to tackle the problem that is coming from outside. So if from outside the demand is being reduced because of the tariffs, because of the trade policy uncertainty, the external demand or the export demand is reducing, so at least the internal demand should be sufficient. Okay, so if because of the tariff uncertainty, if because of the trade policy uncertainty, because of the tariff imposition, if the export demand is reduced, at least we should have enough internal demand so that the production can continue. With the internal demand, the production can increase and the growth can increase in the country. Okay, taking all these factors into account, real GDP growth for 2025-26 is now projected at 6.8%. Okay, so basically what has happened, that there is strong private consumption, fixed investment, manufacturing is also reviving, services sector is steadily expanding, the economic activities are good in our country, rural demand is strong, urban demand is reviving, investment activity is good, even though there is production and import of capital good that has witnessed some moderation, but the other segments are doing very good. Even for the agriculture sector, above normal monsoon, good progress of kharif sowing, adequate reservoir levels, they have brightened prospects for the agriculture and rural demand also. Then rationalization of GST. So even if the external problems are coming, even due to the geopolitical tensions or volatility in international financial market, so due to these the problem is coming, but still the internal demand and the internal steps, they are helping the economy to keep on growing. Okay, and in August 2025, in the Monetary Policy Committee meeting, the real GDP growth forecast was given at 6.5% for 2025-26. That means it was said in August 2025 meeting, it was said that the real GDP growth is expected at 6.5%, 6.5% for 2025-26. Now in October Monetary Policy Committee meeting, it has been said that the real GDP growth for 2025-26 is now projected at 6.8%, that is higher than before. This has happened because of in the Q1 in August, it was expected that the economy will grow by 6.5%, but in Q1 actually the economy real GDP growth has happened by what percentage? Anyone can tell me? The real GDP growth in Q1 was 7.8%. So you can understand that the Q1 growth was quite high in comparison to what we expected. Okay, in Q2 also in comparison to August, now it is expected that the real GDP growth will be higher, but for Q3 and Q4 it is expected that the growth might be lower, okay, than the previous expectations. And real GDP growth for Q1 of the next financial year, it is expected that it is also going to grow steadily. That is the idea. Chalo. Any confusion anyone has till now? Any confusion? Real GDP growth forecast for 2025-26. It has been increased from 6.5% to what percentage? It has been increased from 6.5% to 6.8% because of the Q1 real GDP growth of 7.8%, and in the Q2 also the real GDP growth is expected to be at 7%, though in Q3 and Q4 the real GDP growth projection is a little lower. Okay, now for the Q1 of the next financial year, that is the financial year 2026-27, the growth projection is around 6%, 6.4%. So this is the idea. Now quarterly data you don't have to remember for the first quarter, and the rest of the quarterly data is not important, but remember that for Q1 and Q2 it is expected that the growth will be good, and that's why the projection has been increased from 6.5% to 6.8%. Now coming to next point, that is inflation outlook. Headline CPI inflation declined to its 8-year low. So headline inflation, this is also called retail inflation. This is the CPI inflation. That is the inflation that affects the consumers. This is the inflation, headline inflation, retail inflation, CPI inflation. This is the inflation that affects the consumers. This is the inflation that affects the consumers. Okay. So headline CPI inflation declined to its 8-year low of 1.6%. So headline inflation, you can understand that the inflation came down to 1.6% in July 2025 before rising to 2.1% in August, its first increase after 9 months. So CPI inflation was continuously decreasing and it came down to 1.9%. So CPI inflation came down to 1.6% in July 2025. And then it increased to 2.1% in August 2025. That was the first increase. After 9 months. Benign inflation, that means inflation condition is good. The inflation target is 4% plus minus 2%. That means we want the inflation to be in the range of 2% to 6%, and the inflation should be around 4%. So you can understand that currently the inflation is very, very low. It is around 2.1% in August. Okay, so if the inflation is low, that means there is benign inflation condition. There is good inflation condition. It is quite low. During 2025-26, so far have been primarily driven by a sharp decline in food inflation. So why the inflation is decreasing? Why the CPI inflation? Why the consumer price index inflation is decreasing? This is because of the food inflation, because of the decline in food inflation. Okay, so food inflation remained elevated at 6.7% in 2024-25. Food inflation recorded an intra-year peak of 9.7% in October 2024. But in financial year 2025-26, from since the start of the year itself, we can say the food inflation started to decrease, and in April till August, we can say in the first half of the financial year 2025-26, the CPI inflation has been remained low. Okay, so in financial year 2025-26, the food inflation is low. Because of the low food inflation, there is the CPI inflation that is decreasing. Okay, so CPI inflation was high. CPI inflation was high in 2024-25, or it was on the higher side in 2024-25 because of the food inflation that was high. But now in 2025-26, we can see in the current financial year, we can see that the CPI inflation is declining because of the declining food inflation. This is the idea. Okay. Now, this is the data point that was given in the annual report of RBI. That's why it is important. Now, inflation within the fuel group moved. Now, CPI inflation, this depends upon the food inflation. This depends upon the fuel inflation, and for the manufactured goods, clothes prices, footwear prices and such. Okay. So basically the inflation within the fuel group moved in a narrow range of 2.4% to 2.7% during June to August. So you can understand that the inflation is less in the fuel group also. In the fuel also the inflation is less. Core inflation is your CPI inflation excluding food and fuel prices. That is the volatile prices, food and fuel prices. That is volatile prices. So core inflation, that is CPI inflation excluding the food and fuel prices, excluding the volatile prices. So core inflation remained largely contained at 4.2% in August. So core inflation, if we exclude, see, food inflation is declining in the financial year 2025-26. Fuel inflation is within the range of 2.4 to 2.7%. So that is also less. Okay. If we see the core inflation, that is the CPI inflation excluding food and fuel prices, excluding these prices, if we see core inflation, that has remained around 4.2%. So that is also around the target of 4%. So basically all the inflation criteria for food, fuel, core inflation, all the categories, they are not very high. The inflation is not very high in any of the criteria, and that's why the CPI inflation is low in the country. Now, excluding precious material, if we exclude the precious metals like gold, because gold prices are rapidly increasing, so if we exclude the precious metals, the core inflation was at 3% in August. So core inflation was even lower in August if we exclude the precious metals like gold. Next is in terms of inflation outlook for second half of 2025-26 from October till October 2025 till March 2026. If we see healthy progress of southwest monsoon, higher kharif sowing, adequate reservoir levels, comfortable buffer stock of food grains, they will keep the food prices low. They will keep the food prices low. They will keep the food inflation low. The recently implemented GST rate will also reduce the prices in several items in the consumer price index basket. Okay. Overall, the inflation outcome is likely to be softer. That means it is expected that in August 2025 Monetary Policy Committee meeting, it was announced or it was projected that the CPI inflation for 2025-26 is going to be 3.1%. So CPI inflation for 2025-26 is going to be 3.1%. Now it has been seen that food inflation is further declining. There is further GST that has been rationalized, so the prices are going to decrease because of the rationalization of GST, because of the streamlining of GST, the prices are going to further decrease. So it is said that there is going to be even a softer outcome in the inflation, and that's why, considering all these factors, CPI inflation projection for 2025-26 has been reduced now to 2.6%. So in August 2025 Monetary Policy Committee meeting, it was said that the CPI inflation will be 3.1% in 2025-26, but now the projection has been reduced to 2.6%. So you can understand that it is expected that the inflation for this financial year will be even lower. This is because of the GST rate cuts and benign food prices, lower food prices, despite the anticipation of moderate momentum during second half year, or we can say from October 2025 till March 2026, it is said that there will be moderate momentum. That means the inflation is going to be moderate, not very low. Large unfavorable, because of the large unfavorable base years. Because if we compare the quarter 3 and quarter 4 of the current financial year with the previous financial year, then there is unfavorable base effect, because in the quarter 3 and quarter 4 of last year the inflation was very low. So if we compare the inflation of the coming quarters with the past year quarters, okay, basically if we are doing the comparison of quarter 3 and quarter 4 with the past year and the current year, quarter 3 and quarter 4. So in the past year, there was very low inflation. Okay, so there is unfavorable base effect because we are comparing the new quarters, the coming quarters, with the previous quarters that had very less inflation. So there is unfavorable base effect. Okay, due to which in the current quarters, in the quarter 3 and quarter 4, it might seem that the inflation is on the higher end, but that is only because of the unfavorable base effect, because in the previous year's quarters there was very low inflation. So this is the idea. So when we do the percent to percent comparison, so now the prices might seem on the higher end, but still the prices will not rise much. So this is the idea that inflation outcome is likely to be softer than that was projected in the August MPC. August MPC, the projection was 3.1% of CPI for 2025-26, but it is said that now the CPI inflation projection is given at 2.6% for 2025-26. This is because of GST rate cuts, decrease in food inflation, and it is anticipated that in the second half, that is in the third quarter and fourth quarter of 2025-26, because of the large unfavorable base effects, they are likely to exert upward pressure on the headline CPI inflation for the quarter 3 and quarter 4 of the current financial year, especially in quarter 4, but that will not be much effective in changing the inflation rate. So basically MPC observed, basically in June 2025 MPC meeting, it was said that the inflation, CPI inflation for 2025-26 is going to be 3.7%. Okay, for in August 2025, it was projected that the CPI inflation for 2025-26 is going to be 3.1%. But now in the current Monetary Policy Committee meeting in October, Monetary Policy Committee meeting, it has been said that the inflation, CPI inflation, is projected at 2.6% for 2025-26. So even the headline inflation for 2025-26 is now projected even lower, is now revised to even a lower percentage than your June projection and August projection. So this is the idea. Now if we compare the quarterly data, that means for quarter 2, quarter 3, quarter 4, for these quarters, you can see that for these quarters the inflation projection has been reduced from the previous projection. So in August, the bracket data is the August 2025 projections, and now in October 2025 the MPC has projected even lower CPI inflation. Okay, so this is the idea. Now in quarter 4, you can see that the CPI inflation will be higher in quarter 4 in comparison to other quarters. Now in quarter 4 specifically, because of the unfavorable base effect, because the quarter 4 of the financial year 2024-25 was very low. In the quarter 4 financial year of the previous year, the CPI inflation was very low. If we compare the current quarter 4 of the financial year 2025-26, because of the unfavorable base effect, in this quarter the inflation is seemingly a little higher, but still the prices will not increase much. This is the idea. Any confusion? Now, so this is the idea that headline inflation for quarter 4 and quarter 1 of the coming financial year, that is 2026-27, will also be higher because of the unfavorable. This is basically because of the unfavorable base effects, because we are comparing the current quarters with the previous year quarters, and in the previous year quarters the inflation was very low, so there is unfavorable base effect. Okay, there is unfavorable base effect. Now, next is growth outlook remains resilient, supported by domestic drivers despite weak external demand. External demand is weak, but the internal domestic drivers are very good, and it is said that there will be higher real GDP growth in 2025-26 at 6.8%. Significant moderation has come in inflation, and there is also the growth that is happening even with the global uncertainties and tariff related developments. They are likely to decrease the growth, but there is domestic drivers, there are internal demand that is good. Okay, now front loaded monetary policy, because I have told you that already in February 2025, April 2025, June 2025, the repo rate was decreased. so that the interest rate can decrease in the economy, and with lesser interest rate, more loans can be taken. With more loans, there will be more demand. With more demand, there will be more production, more growth in the economy. So already the repo rate has been decreased by 1% from 6.5% to 5.5%. So already there is front-loaded monetary policy action that was taken of reducing the repo rate continuously from 6.5% to 5.5%. As well as recent fiscal measures, government has also taken the measures of rationalizing the GST. There is streamlining of GST that has happened. So these effects are still playing out. The repo rate has been decreased and its effect is still playing out in the economy, and the fiscal measures that have been taken, their effect is also playing out. So basically, it is said that we will wait. The MPC has said that MPC is waiting, Monetary Policy Committee is waiting for the impact of policy actions that were taken previously to play out and greater clarity to be there. So that's why policy rate has been kept unchanged at 5.5%. All the Monetary Policy Committee members, the 6 members, they unanimously agreed to keep the policy rate unchanged at 5.5%. Okay. So this is the idea. The MPC has also decided to keep the stance neutral, but actually there were 2 members that said that the stance should be changed from neutral to accommodative. Okay, but the other 4 members said that the stance should be neutral only, and that's why the stance majority has said that the stance is going to be neutral. Any confusion anyone has? Any confusion here? So this is the basic idea. I hope this is clear. Okay, so basically in the quarter 1, in the quarter 1, in the quarter 2 also, the inflation. So inflation was projected at these percentages in August 2025 meeting. Now in October 2025 meeting, it has been said that the inflation projection is even lower. Inflation projection is even lower. Okay, so the bracket data is actually from August 2025 Monetary Policy Committee meeting, and this data is from October 2025 Monetary Policy Committee meeting. You do not have to remember the data, but remember that the projections have been decreased for the CPI inflation for all the quarters. Okay, but still for quarter 4 of the financial year 2025-26, for the current financial year quarter 4, the inflation is at 4%, that is higher than the rest of the quarters. This is majorly because of the unfavorable base effect, as well as in quarter 1 of the next financial year also the inflation is slightly higher at 4.5% in comparison to the previous quarters. This higher inflation is because of the unfavorable base effects. If we compare these quarters, if we are comparing these quarters with the previous quarters, that's why there is an unfavorable base effect that is coming. Okay. Now, repo rate is unchanged at 5.5%, SDF at 5.25%, MSF and bank rate at 5.75%. Financial year 2026 GDP has been revised to 6.8%. Before it was said that the GDP is going to grow at 6.5%. Now it has been said that the GDP will grow at 6.8% in 2025-26. For financial year 26, that is for financial year 2025-26, the forecast for CPI inflation is given at 2.6%, that is lower than 3.1%. Okay. In June 2025 Monetary Policy Committee meeting, after that the governor said that the CRR will be decreased. So basically CRR was said to be decreased by 100 basis points. So it was said that the CRR will decrease from 4% to 3%. In 4 equal tranches, that is by 0.25%, 0.25%, 0.25%, 0.25%. So from 4%, there will decrease that will happen in cash reserve ratio to 3% in 4 equal tranches. September 6, so first decrease has happened in the CRR. The second decrease has also happened in CRR. The third and fourth decrease in CRR by 0.25% will happen in November 1 and November 29. But basically CRR was decreased. Now if CRR is decreased in June 2025 and there is already 2 cuts that have come in the CRR. So CRR is currently from 4%, it has gone down to 3.5%, and by the end of the November it will go down from 3.5% to 3%. So CRR is decreased, that means banks have to keep less reserves. If banks have to keep less reserves with RBI, the banks are left with more money to lend out because the banks have to keep less reserves. So they are left with more money to lend out. Okay. Now, India's current account deficit moderated to 0.2% of GDP in the first quarter of the current financial year. Okay, the net foreign direct investment reached a 38-month high in July 2025. Net FPI recorded, so net FDI, the net foreign direct investment has reached a 38-month high in July 2025. Net foreign portfolio investment recorded outflows of US dollar 3.9 billion in the 2025-26 till now, in the first quarter, we can say, in the first half year of the 2025-26, in the first half year of the financial year 2025, in the first half year of the current financial year, there is the net FPI outflows that have happened. So there is more outflows that is happening of US dollar 3.9 billion. But net FDI that is coming in has recorded a 38-month high of July 2025. Okay, so this is the idea. As on September 2025, India's foreign exchange reserves stood at 700.2 billion. Okay, that is sufficient to cover more than 11 months of merchandise exports or merchandise imports. So good imports. So basically, the important data is that the current account deficit in the first quarter of the current financial year was 0.2% of GDP. Next is net foreign direct investment reached a 38-month high in July 2025. So we are receiving a lot of foreign direct investment. Net FPI recorded outflows. So in the foreign portfolio investment, there is outflows that is happening more of US dollar 3.9 billion. So this much of the extra outflows that has happened in the first half of financial year 2025-26. Okay, as on September 26, 2025. India's foreign exchange reserves stood at 700.2 billion, sufficient to cover 11 months of the goods imports. Okay, a question has come from this point in the last year RBI Grade B Phase 1 examination. Now the liquidity adjustment facility. So average daily surplus of 2.1 lakh crore since the last MPC meeting of August 2025, as well as the CRR was also decided to decrease by 100 basis point, that is by 1% from 4% to 3% in 4 equal tranches, and already the CRR has been decreased from 4% to 3.5%. In September 6 and October 4. Okay, so this is the basic idea. So with the decrease in CRR as well as with the 100, so basically by 1st October there was the decrease in CRR from 4% to 3.75%. Then on 4th October, the CRR is further decreased from 3.75% to 3.5%. Now in November, the CRR will be further reduced from 3.5% to 3.25% and 3%. So CRR target is to reduce it from 4% to 3%. Okay. Next is repo rate has been decreased by 100 basis point from 6.5% to 5.5%. So repo rate has been decreased by 100 basis point from 6.5% to 5.5%. Okay, from 6.5% to 5.5%. So first decrease was in February, then in April, then in June. This repo rate has been decreased from 6.5% to 5.5%. That is by 100 basis point, due to which the weighted average lending rate of the scheduled commercial bank. So if repo rate is decreasing, the interest rate for the lending has also reduced by 58 basis point, that is by 0.58%, as well as the deposit rate, the weighted average deposit rate has also decreased by 106 basis point, that is by 1.6%. So with 1% decrease in repo rate, there is decrease in the interest rate for lending, that is weighted average lending rate has decreased by 0.58%. And the deposit rate, the interest rate for deposits have decreased by 1.06%. Okay, so this is the idea. Any confusion, anyone? This is more important for RBI. It is not so much of the details is not important for SEBI. It is more important from RBI. Okay, so we have discussed so this is the Monetary Policy Committee that we have discussed. So basically, let me summarize the points. So here you can see that first we discussed about the Monetary Policy Committee and the rates, repo rate, SDF, MSF have been remained unchanged. Then we discussed about the global economic condition where the US and China growth is there. Okay, but the inflation condition is also higher. That means inflation is higher than the target in major advanced economies. So to control the inflation, they might increase their policy rate. This is the expectation. That means they might increase the interest rate. With higher interest rate, less loans will be taken, less demand will be there. With less loans, less demand, and inflation will be controlled. With less demand, the inflation will be controlled. So it is expected that the policy rates might increase, due to which the treasury yields, the government bond or government security interest or yield is increasing for US and for such advanced countries. Okay, then we discussed about the domestic condition, that the real GDP growth was at 7.8% in the first quarter, and the real GVA growth was 7.6% in the first quarter of the current financial year. So the conditions are good in our country. In the demand side, private consumption, fixed investment. In the production side, manufacturing is reviving, and there is steady expansion in services. Okay, in the agriculture sector also there are good news, that above normal monsoon, good progress of kharif sowing, and adequate reservoir levels, and rationalization of GST has happened, due to which the prices are decreasing. So all of these conditions are there, the good conditions, the domestic conditions are good, but because of the external volatility, there is downside risk that are coming, and due to which the real GDP growth for 2025-26 is now projected at 6.8%. Okay, in comparison to 6.5% that was forecasted before. Inflation, so headline CPI inflation is at the 8-year low. The CPI inflation is at a 8-year low of 1.6% in July 2025, that increased in August. Now there is low food inflation. The fuel inflation is also not very high, as well as the core inflation was also low. It was 3% in August, excluding the precious material, but including the precious materials, it was 4.2%. So basically, the inflation conditions are also fine only for quarter 4. Only for quarter 4, especially in quarter 4. In the second half, in quarter 3 and quarter 4, it was said that there is large unfavorable base effect, due to which the CPI inflation will be higher in quarter 3 and quarter 4 of the current financial year, especially in the quarter 4. So that we also saw that in quarter 4, the inflation percentage is higher than the other quarters. That is because of the unfavorable base effect. Okay, as well as it is said, considering all these factors, CPI inflation for 2025-26 is now projected at 2.6%. Even with unfavorable base effect in quarter 4 of 2025-26, the CPI inflation is expected at lower percentage. Then we discuss the summary. There is front-loaded monetary policy action, decreasing the repo rate from 6.5% to 5.5%. This was done from February till June. So this is it, the extra points. This was given in governor's statement. This was given in governor's statement. This was about the external sector, and this is about the liquidity and financial market condition. So this is it. Now these are the questions in front of you. So the MCQ based question, I will bring that in the MCQ based question from this article. I will be bringing it in the marathon session that will happen on 15th. Now for now, you have to tell me that what is the real GDP growth projection for 2025-26, what is the CPI projection for 2025-26, repo rates, SDF rate, MSF rate, that has been notified in the October Monetary Policy Committee meeting. Okay, chalo, done. As well as you have to tell me that the CRR has been decided to reduce in June 2025. It has been decided to reduce it from 4% to 3%. Now currently, what is the CRR? Because the CRR was not immediately decreased from 4% to 3%, it was decided that the CRR will be reduced in the 4 equal tranches. That is, it will be reduced by 0.25% in September, 0.25% in October, and November 1 and November 29. So till now, the CRR has been reduced from 4% to what percentage? So that is the idea. Now, any confusion anyone has? Any confusion anyone? I tried to provide all the important points because this is the important meeting that has happened. Okay, and I tried to finish it in a faster manner so that you don't have to waste a lot of your time. Yes, very good. Any confusion? Just tell me if there is any confusion anyone has. Got it? So in real GDP forecast, quarter 1, quarter 2 real GDP was higher. That's why the real GDP growth forecast for 2025-26 for this financial year has been increased. Inflation in quarter 1, quarter 2, the inflation forecast has been reduced. Even for quarter 3 also, the inflation forecast is less. That's why there is, you can see that for quarter 1, quarter 2, for all the quarters basically, for quarter 1, quarter 2, quarter 2, quarter 3, quarter 4, all the quarters, the inflation forecast has been reduced. But still in quarter 4, the inflation is slightly higher than the quarters. This is because of unfavorable base effect. That's it. Chalo. No confusion? Shall I leave then? I have another class also for the paid batch. So I will be taking the leave. If there is any confusion, you can write it in the comment section below. Okay, right now you have to focus on percentages. Do not focus on the nitty-gritties. Just focus on the percentages and the main ideas that why the increase or decrease is happening. That's it. Okay. So this is it. Thank you very much for joining the session. The PDF will be provided.